Life credit score explained before buying a house. Chapter 1. Introduction. In this video, I explain what a credit score is and why it matters before buying property. You'll learn how your credit score affects mortgage approval, what lenders look for, and how to improve it before applying for a home loan. Whether you're a first-time buyer or just getting started, this guide breaks it down clearly. Chapter 2. What exactly is a credit score? A credit score is a 3-digit number, usually ranging from 300 to 850, that represents how likely you are to repay borrowed money. Think of it as a financial report card. It's generated by credit bureaus using data from your borrowing history, credit cards, loans, payment patterns, and more. Lenders use this score to decide 3 critical things: whether to approve your mortgage application at all, what interest rate to offer you, how much money they're willing to lend you. Here's the part most people don't realize. A difference of even 40 or 50 points on your credit score can change your mortgage interest rate by half a percentage point or more. On a property loan spanning 20 or 30 years, that difference can add up to tens of thousands of dollars in extra interest paid over the life of the loan. So this isn't just a number for approval, it directly affects how much house actually costs you. Chapter 3. The 5 factors that build your score. Your credit score isn't random. It's built from 5 main ingredients. 1. Payment history, 35%. This is the single biggest factor. Have you paid your bills on time? Late payments, defaults, or accounts sent to collections hurt this the most. 2. Credit utilization, 30%. This measures how much of your available credit you're actually using. If you have a credit card with a $10,000 limit and you're carrying a $9,000 balance, that's a 90% utilization rate, and it signals risk to lenders. Ideally, you want to stay under 30%. 3. Length of credit history, 15%. How long have your accounts been open? Older, well-managed accounts help your score. This is why closing your oldest credit card is often a bad idea, even if you don't use it much. 4. Credit mix, 10%. Lenders like to see that you can responsibly manage different types of credit: a car loan, a credit card, maybe a student loan, rather than just one type. Chapter 4.
What score do you actually need to buy property? This is the question everyone asks, so let's be direct about it. While exact requirements vary by country, lender and loan type, here's a general breakdown. Below 580, considered poor. Very few conventional lenders will approve a mortgage. You may need specialized higher interest loan products. 580 to 669, considered fair. You may qualify, but expect higher interest rates and possibly a requirement for a larger down payment. 670 to 739, considered good. This is the range where most standard mortgage products become available to you. 740 to 799, considered very good. You'll typically qualify for competitive interest rates. 800 to 850, considered excellent. You'll have access to the best rates and terms lenders offer. Here's the key takeaway. You don't need a perfect score to buy property, but the higher your score, the more negotiating power and financial breathing room you'll have.
Even moving from fair to good can meaningfully lower your monthly payment. Chapter 5. How lenders see you beyond the number. Something important to understand. Your credit score is not the only thing lenders look at, but it's usually the first filter. Alongside your score, most lenders also examine debt-to-income ratio. How much of your monthly income already goes toward debt payments? Employment stability. How long you've been in your current job or industry? Down payment size. A larger down payment can sometimes offset a weaker credit score. Savings and reserves. Do you have a financial cushion after the purchase? Your credit score opens the door. These other factors determine how far that door swings open. Chapter 6. Case Study 1. The first-time buyer with a thin file. Let's look at our first scenario. A young professional, early to mid-20s, wants to buy their first apartment. They've never missed a bill payment in their life, But here's the problem. They've also never really used credit. One credit card opened 2 years ago, rarely used. When they apply for a mortgage, their credit score comes back moderate. Not bad, but not strong either. Why? Because lenders don't just want to see that you avoid debt. They want to see a track record of managing it responsibly over time. This is called having a thin credit file. The lesson here, having zero debt isn't automatically a good thing in the eyes of a lender. A track record, even a small one, managed well, is more valuable than no track record at all. This buyer's fix was to keep the credit card active with small regular purchases paid off in full each month, allowing their file to thicken with positive history over the following year. Chapter 7. Case Study 2. The Recovering Borrower. Our second case involves someone who went through a rough financial patch a few years earlier. A period of job instability led to a couple of missed payments and one account going to collections. Fast forward to today, and they're financially stable, earning well, and ready to buy a home. Their score, however, still carries the scars of that earlier period. Most negative marks stay on a credit report for several years, even after the underlying issue is resolved. This buyer took a structured approach. They paid off the collection account in full, requested written confirmation from the creditor, and spent the next 12 months building a spotless payment record. Their score improved steadily, not overnight, but consistently. By the time they applied for a mortgage, they qualified for a good tier interest rate rather than the fair or poor tier they would have faced a year earlier. The lesson here, credit recovery is real, but it takes time and consistency. There's no shortcut that erases history overnight, but disciplined behavior over 12 to 24 months can meaningfully shift your score into a better lending tier. Chapter 8. Case Study 3. The High Income, High Debt Buyer. In this case study, the buyer has an excellent income well above average and assumed that the loan would guarantee mortgage approval. But when they applied, they were offered a smaller loan amount than expected, at a higher interest rate than they'd hoped for. Why? Their credit utilization was high. Multiple credit cards were sitting close to their limits, even though they paid the minimums on time every month. High utilization signals risk regardless of income because it suggests reliance on available credit. This buyer's solution was straightforward but required discipline. Pay down credit card balances aggressively before applying and avoid opening new lines of credit in the months leading up to the mortgage application. Within about 4 months, their utilization dropped significantly. Their score rose and a follow-up application resulted in noticeably better terms. The lesson here, high income does not automatically mean high credit score. Lenders look at how you manage the credit available to you, not just how much you earn. Before applying for property finance, paying down revolving balances is one of the fastest ways to improve your standing. Chapter 9. Case Study 4. The Investor Buying a Second Property. Our final case study involves someone who already owns one property and is looking to purchase a second as an investment. Their credit score is strong. Their payment history is clean. So what's the complication? This buyer applied for a car loan and 2 new credit cards in the months right before submitting their mortgage application, all in preparation for renovations and general life admin. Each of those applications generated a hard inquiry, and the sudden cluster of new credit activity temporarily dropped their score and raised questions from the lender about financial stability. The fix was patience. This buyer was advised to pause all new credit applications for at least 6 months before applying for the investment property loan, allowing the inquiries to age and their score to recover. The lesson here, timing matters. Even financially strong buyers can hurt their applications by making unrelated credit decisions too close to a mortgage application. Before purchasing property, it's wise to avoid opening new credit lines for several months in advance. Chapter 10. Practical steps to improve your score before buying. Let's bring this together into an action plan you can start today. ideally 6 to 12 months before you plan to apply for a mortgage. Pull your credit report and check for errors. Mistakes on credit reports are more common than people think, and disputing them can boost your score quickly. Pay every bill on time, every time. Set up automatic payments if you need to. Lower your credit utilization below 30% and ideally below 10% before applying. Avoid opening new credit accounts in the months leading up to your mortgage application. Keep old accounts open even if you don't use them often. Length of history matters. Pay down existing debt where possible, prioritizing high interest and high utilization accounts first. Be patient. Meaningful score improvement is usually measured in months, not days. Chapter 11. Common mistakes to avoid. Before we wrap up, here are a few mistakes that catch buyers off guard. Applying for multiple loans or cards right before house hunting. This creates a cluster of hard inquiries at the worst possible time. Losing old credit accounts to simplify finances. This can shorten your credit history and hurt your score. Ignoring small unpaid bills, like a forgotten subscription or medical bill, which can quietly go to collections and damage your score without you realizing it. Co-signing loans for other people. If they miss a payment, it affects your credit too, assuming a good salary is enough. As we saw in case study 3, income and credit worthiness are not the same thing. Chapter 12. Conclusion and final thoughts.
Your credit score is one of the most powerful and most overlooked tools in your property buying journey. It's not just a gatekeeper for approval. It directly shapes how much your home will actually cost you over the years through interest rates and loan terms. The good news is that a credit score is not fixed. It responds to behavior. Whether you're just starting to build credit, recovering from a rough patch, managing high utilization, or timing an investment purchase, the principles are the same. Pay on time, keep balances low, be patient, and plan ahead. If this video helped clarify things for you, hit that subscribe button and let me know in the comments, where are you in your credit journey right now? Just starting out, rebuilding, or ready to buy? I read every comment and it helps me know what to cover next. Thanks for watching, and I'll see you in the next one.